Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. In this video, we'll be going over A-Level Accounting 2024 May-June Paper 2-2 question number 4. This is paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour 45 minutes. Since question number 4 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question within 35 minutes. So without any further delay, let's get started. D Limited is a manufacturing company. For the first part, we need to explain 2 uses of absorption costing. The very first use of absorption costing is that it is useful in order to set the selling prices, since absorption costing takes into consideration both the variable cost per unit as well as the fixed cost per unit. Let's write it down. Useful for setting selling prices. Because all costs are included. The second use of absorption costing is that it can also be used in order to value our inventory, as it takes account of the fixed cost as well. Like I said before, absorption costing will value all of the product at the variable cost along with the fixed cost per unit, which is why it can be used for inventory valuation. So useful for inventory valuation. As it takes account of fixed costs. That is all for the first part. Let's move towards the next one. We have been given the additional information. D Limited uses marginal costing. At one of its factories, a single type of product is made, and the following budgeted information is available. We have been given the per unit selling price, direct materials, direct labor, and fixed cost. The factory has a budgeted capacity of 15,000 units per month. We need to calculate the monthly break-even point in units. So the formula for break-even point is total fixed costs divided by contribution per unit. And in this case, we have been given the fixed cost per unit, so we can multiply it to the total number of units in order to get the total fixed cost. So that should just be 8 times 15,000, which results in the value of 120,000. Then for the contribution per unit is just going to be the selling price minus all of the variable cost. In this case, the selling price is given to be 92 right here, and the variable cost will be direct materials and the direct labor. So minus 33 minus 39. This results in the contribution per unit of 20. So our break-even point will be 120,000 divided by 20, which is 6,000 units. That is all for the second part. Let's move towards the next one. We have been given the additional information that it was forecast only 4,920 units would be sold in January 2024. We now need to calculate the forecast profit or loss for January 2024. Since we are talking about marginal costing, we can start with the total contribution. In the previous part, we've already calculated the contribution per unit to be 20. And in this case, we know that we have a total of 4,920 units. So the total contribution will be 4,920 times 20, which results in the value of 98,400. Then we just need to subtract the fixed costs. And this will be the total fixed costs, which again, we've already calculated before to be 120,000. In this case, we can clearly see that the fixed cost is higher than our contribution, which will result in a loss. So the loss will be of 98,400 minus 120,000, which is 21,600. That is all for the third part. Let's move towards the next one. we have been given additional information. The directors have set a target profit of 150,000 per month. We now need to calculate the number of units to be sold in order to achieve the target profit. So in order to calculate these number of units, we can just follow the statement of the marginal costing. We can start with the number of units. Then we can multiply the contribution per unit to it so that we can get our total contribution. From the total contribution, we subtract the fixed costs, and that will give us the profit. So in this case, we now just solve this equation in order to calculate the number of units. We've already calculated the contribution per unit to be 20. The fixed cost was 120,000, and in this case, the required profit is of 150,000. So the number of units is just going to be 150,000 plus 120,000 divided by 20, which will result in 13,500 units. That is all for the fourth part. Let's move towards the next one. We have been given additional information. At another factory of D Limited, a single different type of product is made. The following budgeted details are available for 1 month's production. So again, we have been given the per unit values for direct materials, direct labor, other variable costs, and contribution. Normal capacity at this factory is 18,000 units per month. Recently, the factory has been operating at 80% capacity. So the current level of output is 80% of the normal capacity. So 18,000 times 80%, which results in 14,400 units. And by producing these units, the factory was able to result in a monthly profit of 150,600. So the first thing we can do with this information is, since we have the contribution and the list of our variable costs, we can calculate the value for the selling price, because we know contribution is equal to selling price minus the variable cost. So contribution is 24, we don't know the selling price. We have the variable cost of 16, 17, and 3. So the selling price in this case will be 24 plus 16 plus 17 plus 3, which results in the value of 60. So this is the selling price per unit. Let's take a look at the information. The directors have been informed that a major competitor manufacturing the same product plans to stop production. The directors plan to take advantage of the situation and are considering two options. For option A, we now need to increase monthly production by 6,000 units on current output levels. So now the number of units for option A is going to be current output level, which was 14,400. And we will increase this by 6,000 units. So the total will be 20,400 units. Then we need to sell all production at a price per unit 2% above the current price. So we need to increase the selling price by 2%. Previously, we calculated the selling price to be 60. Now we need to increase this 60 by 2%. This results in the value of 61.2. Then any production above normal factory capacity will require direct labor to be paid an overtime premium of 50%. Okay, so overtime premium will be 50% of the direct labor rate. The direct labor per unit is 17. So 50% of 17 results in the value of 8.5. And this is the overtime premium to be paid per unit. And we only need to pay overtime for any production above the normal factory capacity. In this case, we had been given the normal capacity of 18,000 units. So the excess units in this case, we take the total, 20,400, and subtract the 18,000. So we have 2,400 extra units on which we need to pay this overtime premium of 8.5 per unit. Let's take a look at our question. We need to calculate the monthly profit to be made from option A. Okay, we can start with the revenue. We know that we will be selling a total of 20,400 units at a price of 61.2 per unit. So the total revenue will be 20,400 times 61.2. This results in the value of 1,248,480. Then we can subtract our variable cost. We can start with the direct material. For option A, there was no change to be made on the current price for direct material per unit, so we can use the same value of 16. This results in the value of 326,400. Then we will subtract the direct labor. For direct labor, we'll pay the normal rate for all 20,400 units, and the normal rate was 17 per unit. And for the excess units, for these 2,400 units, we also have to pay an overtime premium of 8.5 per unit. So that will be 2,400 times 8.5. This results in the value of 367,200. Then we also have, I think, the other variable cost, and that is 3 per unit. So other variable costs will be 20,400 times 3, which results in the value of 61,200. Now we can calculate the contribution because we've already included all of our variable costs. So the contribution will be the total of these four values: 1,248,480 minus 326,400 minus 367,200 minus 61,200, and this results in the value of 493,680. From the contribution, we need to subtract the fixed cost. And in this case, okay, we also need to calculate the fixed cost because in this case, we have been given the monthly profit, which is for 14,400 units. So again, we use the same equation. We can start with the number of units, multiply this by the contribution per unit, subtract the fixed cost, which will result in the profit. And in this case, we will be solving for fixed cost. So the number of units is the current level, which was 14,400 units. The contribution per unit is given to be 24. We don't know the fixed cost. And the profit is given to be 150,600. So the fixed cost in this case will be equal to 14,400 times 24 minus 150,600. This results in the value of 195,000. So we'll be using the same fixed cost because there is no additional information given regarding fixed cost within option A. So we subtract the 195,000 and this will give us the monthly profit. That will be 493,680 minus 195,000, which results in 298,680. That is all for the fifth part. Let's move towards the next one. For the next one, we need to prepare a monthly marginal costing statement for option B. Let's go over the additional information given for option B. We need to increase factory capacity to 22,000 units per month. So this will be our new number of units under option B. We will be selling all production at a price per unit 3% above the current price. In this case, the current price was 60 per unit. So now we need to increase it by 3%. So the new selling price will be 60 times 1 plus 3%, which results in the value of 61.8. Then suppliers of direct materials will be expected to offer a trade discount of 25% instead of the current trade discount of 20%. Okay. So the value of 16 per unit for direct materials is after allowing for the trade discount of 20%. So the initial direct materials times 1 minus 20% because we are getting a discount will be equal to 16. So the original direct material is 16 divided by 1 minus 20%, which results in value of 20 per unit. Now, instead of the current trade discount of 20%, we will be getting a trade discount of 25%. So the new direct material price per unit will be equal to 20 times we need to discount it by 25%, which results in the value of 15. So this is the new direct material per unit. Then the direct labor rate per unit will be increased to 18.50. So this is the new direct labor per unit. Then some additional machinery will be purchased at a cost of 120,000. Machinery is depreciated by 20% per annum using the straight line method. And in this case, we have been asked to calculate the monthly profit. So we also need to calculate the depreciation per month. Since this is the straight line method, we can just multiply the rate to the given cost. So 120,000 times 20%, but this will result in the depreciation for 1 year. We need to divide it by 12 in order to get the depreciation per month. This results in the value of 2,000. Then an additional 20,000 per month will be spent on advertising. This is another fixed cost. So the new fixed cost, we can start with the previous fixed cost of 195,000. Then we need to add the depreciation per month as well as the advertising cost, which results in the value of 217,000. Since we have calculated everything, we can start with the revenue. And in this case, we have a total of 22,000 units and a selling price of 61.8. So the revenue is just going to be 22,000 times 61.8. This results in the value of 1,359,600. Then we will subtract the direct material. For direct materials, we calculated the new price to be 15 per unit. And we have a total of 22,000 units. So 22,000 times 15, which results in the value of 330,000. Then we can subtract the direct labor. For direct labor, the new rate per unit is 18.5. So 22,000 times 18.5 will result in the value of 407,000. We also have other variable costs, and there was no changes for other variable costs, so we can still use the value of 3. So 22,000 times 3, which results in the value of 66,000. Alright, now we can calculate the contribution. It will be the total of these four values: 1,359,600 minus 330,000 minus 407,000 minus 66,000, which results in 556,600. Then we need to subtract the fixed costs. And we've already calculated the new fixed cost under option B to be 217,000. Then we can get the monthly profit. That will be 556,600 minus 217,000, which results in 339,600. That is all for the sixth part. Let's move towards the next one. We now need to advise the directors whether or not they should go ahead with either of these options. We need to justify our choice by discussing both financial as well as non-financial factors. So in this case, the question is of 7 marks. 1 mark will be reserved for the final decision. Then we also need to discuss either of these options. So 2 marks will be for option A, 2 for option B, and 2 for both the options, because we can choose both or we can choose neither of these as well. So let's start by comparing the profits. For the current level, we have a profit of 150,600. For option A, we got the profit of 298,680, which is higher than the current level. And for option B, we got the profit of 339,600, which is higher than the current level as well as option A. Okay, let us first consider option A. For option A, we made no changes to the fixed cost. So we can see that this is less risky because there is no permanent increase in fixed cost. But for option B, we can see that we made changes to the fixed cost by introducing a new machinery as well as new advertising expenses. Let's write it down. It is less risky as there is no permanent increase in fixed costs. Another thing that we need to consider for option A is that we are also providing overtime premium in excess of the normal capacity. So whenever there is overtime premium, we can always ask the question whether or not the labor force is prepared to work these overtime hours. Let's write it down. Are labor force prepared to work overtime? Now we can move towards option B. Option B was the most profitable outcome. So has a higher profit than both the current level and option A. And for option B, we are considering expending more on advertising. So whenever there is advertising, we can always ask the question whether or not this advertising will be effective. Let's write it down. Will the advertising be effective? Then we need to consider both the options. So the first thing we can write is that both options are more profitable than the present situation. So both options are more profitable than present situation. And in this case, we are considering both these options because the directors have been informed that a major competitor manufacturing the same product plans to stop production. So before starting with either of these options, we also need to understand why the competitor has ceased production. Because if there is likely to be a fall in demand in the future, then the business should not go ahead with either of these options. Let's write it down. Is there likely to be a fall in demand? Now we need to make a final decision. In this case, for option B, we will be producing a total of 22,000 units, whereas for option A, we will be producing a total of 20,400 units. So in this case, I would suggest to go ahead with option B, since a higher number of units will result in a higher revenue along with a higher monthly profit. Let's write it down. So the decision is, I would advise the directors to go ahead with option B as it has a higher number of units along with a higher profit. These higher number of units is likely to satisfy the demand of the competitors' customers. Alright, that is all for this question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.